Okay, so as we said, we're starting out at 700,000 in free cash flow, and what does that mean for us when we go to figure out what's the true capex number? As we said, there's a lot of big numbers in here proportionally that kind of skew this number down. We said we're not going to have that massive uh, upgrade to our systems in the foreseeable future, so I think we have to take out that 800,000 that we're going to have in the near future. So there was 400 of it already accounted in here. So I think we need to reduce out that from our capex number. And I think we have to smooth out our Cobalt 60 usage. So if we think about what we spend about 900,000 each year for Cobalt 60. And so we have to take out that Cobalt 60, the total amount, but then kind of smooth it out over time. Jay's tool here does a very nice job of allowing you to adjust the year over year cash flow numbers so that we could take that into account every single year. I'm just going to try and smooth it out over the number of years that we're going to use it. So we spent 900,000 over these 2 years for this Cobalt 60. Um, so if we take out the 900,000 each year, we get an adequate capex number, but then we have to add back what we're actually going to use throughout the year. So how long is that going to does that have a useful life? Well, this is where the 10K becomes helpful as well. So if we go into the 10K, we can find under our depreciation bear with me as we look through it here. Okay, so as of here, the total cost base of a Cobalt has been depreciated using engineering estimates from published tables under which one half of the remaining value is written off over 5.26 years. Um, so basically, they're depreciating it over 5.5 or 5.25 years, which is the half-life of the Cobalt 60. So the useful life of this is 5 years. So we're going to use the Cobalt we buy over 5 years. So it sounds reasonable that we should divide it by 5 years. So we spent 180,000 or 1.8 million, excuse me, on Cobalt over the last 2 years. So the average should be about that divided by 5. So we come out with about 3.6 3.6 or I'm sorry, 360,000 each year in actual capex if we were to smooth this out. So 360,000 taken out of this or added to this capex number minus the 900,000. So we're going to pick up another. Let's do this real quick here. Over here, we'll say equals 1.4 million minus 0.9 for our 900,000 plus our 0.36. We have a capex of $860,000 per year. Seems like a reasonable number. Um, in addition to that, we need to take out our 400,000 that we spent on our equipment, and the upcoming equipment expenditure looks like it's going to be paid with cash. If you saw on the balance sheet, they were kind of hoarding cash over this time period a little bit, and it seems to be, given their nature of not taking on debt, that they're going to end up paying for that equipment straight out of their cash. So we're not going to see that as a cash flow type expenditure in the future. So it's going to be a one-time thing. It's going to come out of cash. So I think we can ignore that in our free cash flow. So we take out that 400,000, and we'll assume that we'll have normal warehouse upgrades and everything over time. So we'll leave those into our capex number. So we take out the 900, we add back the 360,000, and we subtract out the 400,000, and we get 460,000 in capex. So what is our true free cash flow number? Let's say we say 2.1 minus 0.46, and we get a number of $1.64 million. We'll delete that out of our spreadsheet. So we're going to assume that our starting free cash flow is at $1.64 million over time, because we're not going to have this capex over many of the years going out. Okay, so what about growth rate? So we look at growth, and it comes up at 12.1% right now, and this is probably where I get a little more qualitative in my analysis. And if you look at their free cash flow growth over time, there hasn't been a lot. It's been in the zeros. It's been 29, and then it goes to 0, and then it's 32, and then it's down. It's all over the place. But the median is 12.1. Well, if you look at the 10-year performance, 35, 70, it's a very broad number. It goes all over the place. I think this number is low, given that they're a small company and that they're using their capex or their capital, their fixed assets, to grow revenue. Revenue has been growing, and as revenue grows, their margins have grown. Therefore, gross income or net income should be growing faster than revenue should be. And as we saw, revenue is growing about 13% a year. So 13% should really be our bottom line on this, given that as revenue grows at that rate, our free cash flow should grow at a faster rate. So I can get behind this being a little bit higher, and I think 13% is our starting point. And how much higher? I think I can justify an additional 3% growth on this over time, because we're talking about going out 10, 15 years, or 20 years even. That they can grow this by another 15% every year. So we can add another 3% to this growth rate, and we'll come up with our growth rate. In addition to this is much more qualitative, but you have to understand what they do and how society has changed over time. They're in the business of food irradiation, which means that they are providing food safety. When you do food safety and you look at our society as a whole, food safety is becoming much more important. People buy organic because they don't want pesticides on their food. You don't want pesticides on your food. You still want it to be safe from pests. Irradiation may be an option. I just don't see society going back in time on their stance on germs and bacteria and that. I think we're only going to become more aware and more conscious of food safety and medical supply safety in the future. So I think the growth potential here is much higher than what it's shown before. And I can justify the growth rate that way, that's saying that there's just such a big market for this type of process, and given that they only have one plant, they have a long runway of potential expansion opportunities out there. Plus, you can say that they have this nice economic moat where a lot of companies don't want to go into this arena because it's quite literally a radioactive topic. People don't want the liability of being in the radiation business if they're not already in it. So I think there's some barriers to entry in getting a license and all the regulatory hoops you'd have to go through to enter the market. Plus, they had an advantage as well. One of their largest shareholders until last year was Noridian, which was the largest supplier of cobalt-60 out of Canada. They were a major shareholder of Food Technology Services. So they have a relationship with a key supplier to a key ingredient in food irradiation. They own they have a big tie to their major supplier. They no longer own those shares. They were sold to Fort Ashworth, which is a private equity firm, which now owns 27% of the company. But they have this relationship, so they're getting very, very favorable pricing on their cobalt-60, which gives them an additional advantage as well. So I think 15% is okay to use in this number. Plus, they're small companies, so they should have more growth potential as well. Okay, so we keep going on here. I can get behind 15% on this just based on their They're nice moat being in a radiation business and having a nice relationship with a major supplier of the radioactive material, who was the shareholder at one time. Now a large private equity firm, Ford Ashworth, owns a large portion of the company. So I can get behind that, 15%. The discount rate. As you've seen in the last couple ones, I tend to be a little more aggressive in the discount rate. And on this one, on the financials, I can say, yeah, I think this is a good one to discount a little bit further. If we do our quick score here, we get the 45, which means that we could drop this down. We get a 45 score out of 60 here, which means how I do it, I get to about 9% discount rate. However, being a small company, I think there's some pause here on going down to 9%. No, there's a couple reasons for this. First one is it trades very, very thinly. There's not a large market for this. This isn't like Oracle or Apple or any of those big companies where you could buy $3 million position and liquidate it that day and not really have an effect on your price. They don't trade that big. So any type of transaction that you do with them, you're going to have to be very careful about liquidity constraints. Also, another thing is that they are majorly owned by a private equity company. They are owned by Fort Ashworth, which owns about 27-28% of the company. So that could give me pause too on how much control I would have over my shares. When one company has control, that gives me a little bit of pause. It could be a good thing that they can make changes rapidly and get the growth going. So maybe I'm a little more aggressive on the growth because of that, but there's a little more risk as well, so I'm going to discount it back. So I think that adds back. So I think 12%, given their strong financials and given that risk, I think we come back to about 12% on this. So we have 12%, 15% growth, and then we'll start with our free cash flow. We get to 1151. So under my margin of safety 50%, this looks good, like a good buy here. And if you'll notice, the date changed here. I started on February 7th. Some things came up, so now it's February 9th. And it's gone down a little bit since I've done that as well. But I still think it's a good buy on the free cash flow basis. But let's look real quick at owner's earnings. Owner's earnings is significantly less. So we look here, it starts at 0.1 instead of 0.7. And the reason for that is this tax asset that they have out there, this deferred current income taxes that they had, makes a difference in their earning the owner's equity. So owner's equity, you can't really take out the tax asset or the cash flow benefit from deferred taxes because you're eventually going to have to pay it. So owner's earnings is probably a little bit better metric in this case. So we need to take that out as well. So let's take out 0.6. That's about 600,000. We get to a little bit over $1 million. Again, I think the growth is still the same. I think the discount rate's the same. So we hit refresh. Now we get to 32%. So which one do we do? What do we do when these two things conflict? I'm going to say watch and wait for you. I will say I do have a position in this company, but that's because I got to use a different discount rate. When I told you guys at 12% because of liquidity constraints, my position is so small that I don't really have those liquidity constraints. So I got to use a lower discount rate than you guys do, and it so I was able to take a position in this company, but I can't recommend that for somebody that's going to drop larger dollars on it. And if people start watching this and start looking at it, there may be some liquidity constraints on people getting in and getting out later. So I thought a 12% discount rate is fair for somebody with a larger position. So what do we get to? We get to a 50-50 split here on whether or not to look at it. I encourage you to look at this at the company. I encourage you to look at the financials and read it. And please continue to comment and post and ask questions. And please give me some more ideas on companies that you would like to see down the road. Next week we will be doing General Mills, or in 2 weeks, we'll be doing General Mills per somebody's request. Thank you.